Morning, everybody.
Morning, Gareth.
How's it? How you doing?
Awesome. Thank you.
Good.
Looking forward to your talk.
Me too, actually. I think given kind of where the economy is, I think it could be quite relevant. So yeah, quite excited too.
Fantastic. Fantastic. I think I see we've got 292 people already on the call and numbers climbing.
Okay. So let me know when I think Caesar said we'll kick off at 5 past, or do you want to kick on now already?
Sure. I'm just greeting. I'm not going to change anything. We'll go with Caesar's 5 past.
Okay, cool.
Happy.
And no one can speak back to me, unfortunately.
So Caesar Gele, myself, Tapelo, and Sinetemba can speak to you. Unfortunately, none of the brokers can, but they can chat in the Q&A. So good morning to everybody that's already joined on the call. Morning, Lisa. Morning, Lucy. There's 2 anonymous people on the call. Thank you for putting your name. If your name appears as anonymous, please will you put it in the chat, your name and surname, just so we know how to allocate your CPD hours. Morning, Adele. Morning, Vinay. So there's a lot of good mornings in the Q&A. Gareth?
Okay, brilliant. So
And
because
Helene can chat to
I
you.
can't see any of that at all, right? I think Helene's going to assist me with questions and answers if there are any.
Yeah,
Okay.
I'm happy to do that.
Cool. Awesome. Thank you.
We saw Helene for 2 seconds and then she disappeared.
Lastminute.com. I jump in and just disappear.
Cool. I knew I said I would keep quiet until Caesar said. I think, Gareth, if you're ready to rock and roll, we can start. Yeah, we've got just under 400 people on the call. So for the people that are on, I think let's honor their time. Cool.
Awesome. Fantastic. Thanks very much, everybody, and welcome to the latest installment of iTOOsday. As you can see, all the branding is kind of Hollard. And that's, because our product is Hollard Trade Credit. So it's a Hollard branded business, even though it sits in the iTOO stable. So big shout out and thank you to iTOO for the platform and for allowing us to present some discussion points, and as well as an exciting new product for us in the Hollard Trade Credit team. As always, please I don't know how, but stop me with any questions. I think Elian will handle questions in the comment side. I can't see any. But if you have any questions, please raise them. I'd way rather have some meaningful discussions than me just rambling on for the next 55 minutes. I'm going to try to keep track of time. For those who know me know that that's quite a difficult thing. Anyway, welcome. We got some exciting news. I think the email went out about 2 weeks ago for the Levy Default product. And we're quite chuffed with what it looks like and the way it works. And I'm certainly going to take a few minutes to take you through those. And I'll also then be talking a little bit about the application of trade credit insurance. So some real paint by numbers, examples of how we use trade credit insurance in this economic landscape. And hopefully that'll obviously jog the interest in the solution, and certainly how it's applicable for your clients. And then the last slide there is obviously just next steps. So what to do next, and how do you take this kind of useful information, particularly on the trade credit applications, and engage with your clients in a way that makes you feel comfortable. So I hope that's all right for a departure. Give me a second. I just want to set a timer here. Okay. So Levy Default product, probably the most important thing about the Levy Default product is please drop us an email on levydefault@hollard.co.za. That's the central mailbox that houses all interest in the Levy Default product. If you send it through there, at least we know that the right people that need to address it will be on the receiving end of that. So please drop us a mail on levydefault@hollard.co.za, and we can take you through the product, take you through some highlights, obviously provide all the information that you could share with your clients. Probably the most important part of the Levy Default product when we built it was that it was a standalone solution. In the market, we found that you get the assets, body corporate policy, and a Levy Default almost as an add-on into the solution. And that gets a little bit messy, especially because there are two different types of risks. An asset risk is fundamentally different from a non-payment risk. And including it into one solution is obviously quite a difficult thing to roll out appropriately. An insurer rather had a Levy Default product which exited in about March this year. So I'm pretty sure that the Levy Default product that we built at Hollard Trade Credit is the only Levy Default standalone product in the market. It's taken out and it's addressed for community schemes. So that typically means body corporates or homeowners associations. So call it gated communities. And what we really what turns us on in the trade credit team is it's a really super product that introduces brokers who have body corporates as clients to the trade credit market, and certainly the way the trade credit policy operates, so that we can start getting trade credit insurance as a standard product into brokers' conversations. So the product operates very much like a trade credit insurance solution, but obviously it's geared at body corporates or homeowners associations who previously had no requirement for trade credit insurance. It covers the non-payment of levies. So the body corporate is the policyholder. Oh, no, don't do that. Sorry about that. The body corporate, and I'm going to use them as the example, if you don't mind, throughout, instead of using homeowners all the time. The body corporate is the policyholder, and they ensure the non-payment of all of the unit owners for the levies. We can include water and lights or water and electricity as part of the levy bill, provided it's approved, right, by the body corporate and the trustees when they do a vote with the unit owners, and as well as they are separately noted on the levy statement. It doesn't include things like penalties or fines, or the indemnity at least doesn't include fines or penalties. But like I said, it does include the levy, water and lights, if separately noted on the policy. And the claim triggers once a unit owner is in arrears for 3 consecutive months. Okay, so that's the way the policy works. And the reason why it works like that is if you chat to a body corporate and you understand how they allocate the payment or the remit of levies that have been paid, it always goes to the oldest levy bill first, right? So if a unit owner is out of pocket for January and pays in February, that February payment will be allocated to January, which means that February is now outstanding. If they miss March and miss April, you would now have a trigger under the policy, even though they paid in February, because the February payment went to January, which leaves you with February, March, and April. That becomes a claim under the policy. The body corporate would submit the claim to Hollard. We would indemnify the body corporate, and that 3 months worth of debt would be subrogated to Hollard for a recovery measure. The levy payer or the unit owner is then, the cover is reinstated for a further 3 months. Okay, so technically a body corporate has bought themselves 6 months worth of cash flow with the Hollard Trade Credit Levy Default product. Once a unit owner is defaulted for 6 consecutive months, at that point the unit owner would be removed from cover, but the policy would still remain, and all the other levy owners would still, or unit owners or levy payers would still be included for cover. Okay, so does that make sense? So we're including all of the levy payers, provided, and that's quite important, provided the levy bill is within terms at the time of incepting the policy. And then the only time a unit owner would be excluded from the policy is if they've got 6 months worth of defaults, or 6 months worth of consecutive defaults. Premiums
Gareth?
are calculated. Sorry?
Sorry, the question that popped up is what is the indemnification timeline?
Okay. So the policy will pay out within the same month. That's according to the policy wording. But in reality, what we find is that we normally process a payment within the same week. And certainly in terms of the levy default product, it's a way simpler process. There isn't a confirmation of debt component to it. It's more a case of understanding whether the rules have been applied in the event of the policy being incepted. So the body corporate or the trustees need to have an AGM or an SGM, and the unit owners need to vote for the policy to be put in place. That's one of the conditions in the policy, and it's a part of the proposal form. Once that's in place, to prove a claim is quite a simple thing. It really is a case of saying that the amount is outstanding. And like I said, we should process a claim within a week, even though the policy wording does give us a month to pay out.
And then, sorry, there's 2 more questions that popped up.
Yeah.
So I know you're busy with them. So will interest charged on the outstanding amount be covered?
Outstanding. Okay, and the other question?
And the other question is, if the money is recouped from the owner, can he be re-added to the cover?
Absolutely. Okay, so interest is typically not included under a trade credit insurance policy in any shape or form, and would not be included in the indemnity of the policy. However, a second important condition that needs to be voted in order for the body corporate to become eligible for the levy default product is that there's a 2% per month interest that can accrue on overdue arrears. So that 2% interest per month is a legally stated percentage. So that forms within the realms of the law, and that is required in order for the policy to become effective. As we recover the debt, obviously any interest that does accrue will accrue to the body corporate, so the policy holder will be the sole beneficiary of those overdue or the remaining interest portion of the collected account. Once a unit owner has settled their overdue obligation, so let's just pretend we had a claim for 3 months, we paid the body corporate out, that levy owner was subrogated to us, and we began a recovery process. As we recover those debts, and should all 3 months be settled, and the underlying account, because remember, as we're collecting, there's still monthly levies that need to be paid. As those are being settled and the account is within terms, the unit owner will automatically be included for cover again. Okay, so I hope that answers the 3 questions. Interest is not included in the indemnity. once a levy account is back within terms, post-indemnity, they'll be added for cover again. And I can't actually remember the second question, to be honest. Premiums are calculated on the monthly insured levy bill. So the reason why we do that is because if an estate has 10%, let's say, of their levy payers are in arrears at the time of incepting a policy, we obviously can't bill them for those levies because we're never going to pay out on those levies. So we'd only bill them on the insured levy bill. One of the reasons why we're stuck on this is because it operates a lot like a trade credit insurance policy where there's a declaration of the sales made. So it ties in quite nicely with understanding the logic of a trade credit insurance policy.
Sorry, two
like
more.
this. Yeah, go.
How many times can a unit owner claim in 1 year? And then is there a limit to how many claims can be submitted by a body corporate in 1 year?
Okay, so the answer to that, I mean, the technical answer to that is there's no limitation to the number of insured, so the number of levies that can claim, or the unit owners that can claim on the policy. Technically, all 100% of the unit owners could default, and Hollard Trade Credit would need to respond. And then a unit owner, I'm just trying to think of the practical terms. Whilst there's no limitation in the policy, you have a claim once you're 6 months in arrears, or once they are 6 months in arrears. Let's assume then that on the date that there's a claim, they settled all 6 months in arrears and brought the account back within terms, then technically they'd be able to claim twice because there'd be 2 6-month periods in 1 year. But in reality, I mean, I can't see that happening, and I'd imagine that a unit owner would only be able to claim the 3 months and the 3 months, right, within 1 year. But there's no limitation in the policy wording. If somehow there's a change to the Gregorian calendar, I suppose we could work out a new way to define it. But for now, there's no limitation. If you don't mind, I'm gonna stop the presentation there for now, and I just want to. So part of our pack is a levy default frequently asked questions that we will provide with you, and it really runs through the nuts and bolts of what you need to understand, or what your client, the body corporate, would need to understand in order to take out the policy. So it runs through a little bit about the policy, how do claims work, what are levy clearance certificates. So this one's quite interesting. And obviously, in a policy, we have the right to, I'm not going to say withdraw an indemnity, but to claim back from the policyholder where we've erroneously indemnified them. Excuse me. And the body corporate certainly is not allowed to provide a levy clearance certificate if we're busy collecting arrear levies, right? In the event that a body corporate does produce a levy clearance certificate for a unit owner, even though that we're busy collecting on them, then the body corporate would be required to refund us because we would have paid a levy bill without any ability to recover it, right? So that's a very important component of that. The claim on the trade credit policy does not settle the underlying account between the body corporate and the unit owner, right? The claim is the contra transaction for the premium that they've paid us. Right, so they pay us premium and we settle a claim. Those are the two transactions. But the unit owner's statement or aging in the body corporate set of accounts needs to remain there, and that's why they can't give a levy clearance certificate. And obviously that's the same a debt that has been subrogated to us that we are busy recovering against. But this document takes you through all of those components, and then it takes you through the proper process on how to claim. So there's the 2% arrear levies that I mentioned earlier. Sorry, this is in the way now. And then it goes through processing claims, how long it'll take, and any other information that you need to know. This component here, I think, is really important. Section 4, so the last section of the frequently asked questions, those are just very important components on policy management for the body corporate to make sure that we can indemnify as quickly as possible. And then the second document that we provide from an information sharing perspective is just a little brochure, and that really takes you through some highlights of the policy, as well as some pros in the policy. So these are really the points that you can, belabor with your clients. Standalone product, obviously, it's quite easy to do. It's fairly cheap. Our target premium is about 1.2% of the arrear levy bill, right? So at a 3,000 Rand a month levy bill, you're kind of looking at about 36 Rand. So we try to get away with the logic of kind of, for the price of a cup of coffee or a cappuccino at your favorite coffee place. That's kind of what we went in at. And certainly from what we understand, I think the pricing is quite competitive and certainly appealing to clients. Most important part for us is that is the financial stability for the body corporate. If you understand a body corporate, when they calculate what their levies need to be for the year, that's based on the body corporate or the estate. I mean, not quite breaking even, a little bit more than breaking even, but they certainly aren't. They aren't profit sharing businesses. That's hilarious. They aren't profit making businesses, and as a result of that, if a levy payer doesn't pay, then the body corporate doesn't have enough money to maintain the estate. Whereas this product will then keep those financial the inflows coming through, so that the body corporate will be more financially stable and be able to maintain the estate, which will obviously keep the unit owner's value up. Right. Next, probably really important components, these two sections down here. And that's really about saying that we're professionals in collecting debt, and way easier for us to collect the debt and for us to pick up the legal fees in collecting debt. So that's quite an important component that I haven't added in here. We pick up all the pre-legal and legal fees in recovering that debt. The body corporate gets indemnified, the debt gets subrogated to us, and we collect the debt at our expense. So the body corporate isn't sitting there with all these legal fees that are getting loaded on. And that, like I said, gives them a way clearer financial position. I don't think there's too much. I've mentioned that for enhanced property valuations already. So that's a little bit about the product. Is Helene, any questions on that for now before I move on?
Gareth, there's about 2 or 3. I think you've answered some of them. So there was a question around just confirming the premium rate again.
Okay.
And then another question saying, can you maybe just go through how the premium is calculated? And then that also links to the third question, which is sort of mentioned the fact that you talked about monthly declarations. So is this going to be an annual policy? Can there be changes during the course of the year? Are they going to be able to declare monthly? So I think there's those 3 that link to premium.
Perfect. Okay.
And then 2 questions saying, will we be recovering the outstanding amounts? And I think that answer is sort of self-explanatory, as the intention really is to try and recover the amounts as well as the penalty interest to the policyholders. And then 2 practical questions. Is there a size limitation on the body corporate, i.e. a limited or minimum owners in a body corporate? And then a question was, is Hollard going to assess the body corporate before the policy is put in place? So maybe just through those requirements, possibly that is needed for a policy. And lastly, was the question is must the body corporate be a Hollard client already, or is it truly a standalone policy?
Okay.
Yeah, and then sort of one that's for minimum underwriting considerations.
Okay, so those are quite a lot of questions. Certainly, let's get into so it's standalone completely. Hollard doesn't need to do the assets of the body corporate at all. They're 2 completely different risks for us, so we're not too fussy about that. In terms of the premium, as I mentioned, our target rate is about 1.2% of the monthly arrear, the monthly levy bill. So there would be a levy bill that would already be approved by the body corporate. We would take that total levy bill, and that would be, provided everyone's account is within terms, that total bill would be the monthly declaration. So it's not an annual policy, it's a monthly policy. If the total levy bill is 100,000 Rand, we'd say 100,000 Rand times our 1.2%. And that would be the premium, 1,200 Rand. That would be the premium for the month. Next month, if nothing changes, same thing, 100,000 Rand is declared. and that would go on. If a levy payer defaults and becomes a claim, like I said, for 6 months, then the total levy bill would be 100,000 rand less that unit owner, which let's say then is 97,000 rand. It's 97,000 rand times by the 1.2% for that month and going forward, unless there's a change. So certainly there can be changes within the year and within the month on a trade credit insurance policy, as well as a levy default policy. And that's how it manages it. So it's always the total insured levy bill, which is pretty much the total levy bill minus any arrear accounts at the time of incepting the policy, or any unit owners that have claimed on the policy or that have been subject to a claim on the policy. There's no limitation in terms of the body corporate or the community scheme, but obviously we're going to underwrite the community scheme. And if somebody's got 50% of the unit owners are in arrears, I mean, it's unlikely that the body corporate is going to want that type of policy from us if we're only covering the 50% that haven't defaulted yet. So there is some underwriting that goes through, but the underwriting is at a body corporate level, not necessarily at individual debtor level. Unlike trade credit insurance, which is a business-to-business transaction, so a policyholder is a business who sells to another business, the levy default policy, the unit owner can be an individual or a business or a trust. We don't mind, as long as obviously we can identify them and we can track whether their account is within terms or not. Okay, so I'm going to move on, if you don't mind. This is so the next exciting part. So please, again, last call to action on the levy default. Get in touch with us. Let's have a chat. Some of the brokers have been really great, and they've asked us how we can adopt this into a digital scheme. I don't know is the short answer, but very happy to have conversations, and let's work out the best way that it works for you and your clients. Okay. So applications of trade credit insurance. I mean, you guys have heard me speak about trade credit insurance before on an iTOOsday. It's one of those products that either people don't know exists or it's just too different or too difficult to kind of deal with. But this is really a call to action for me to say, guys, the landscape at the moment is not positive, right? When I speak to brokers, we just hear quite a lot about client churn, and client retention is quite a difficult space to be in. It certainly feels like growth is quite a tough space at the moment. In the trade credit space, closer to home, claims are definitely up, payments extensions up. So we can see that there's a cash flow shortfall in the market at the moment. Fraud is prevalent everywhere. I can't say enough about fraud. And funny enough, we had a broker breakfast last Tuesday where we had a political economist, Daniel Silk, to speak to some of us that attended. And it was really interesting to hear him talk about, the positive sentiment. No load shedding, although that seems to be kind of creeping back into the woodwork if I look at what people are saying might happen in December. But as we are right now, there's no load shedding for 227 days or 228 days now. Interest rates are coming down. Inflation is under control. The GNU, I think, was a landfall in terms of a political a result in the elections. What else? The rand dollar has strengthened significantly over the last year. So certainly there's a lot of positive sentiments and a lot of reasons to feel good. But if you look at the kind of the blood in the streets, you can see that the economy really is in a tough space. And we still have to get there. This positive sentiment that we see is a longer term, medium to longer term kind of sentiment. And it's something that we need to build for. I think we don't necessarily appreciate how tough it's been, certainly in the last 5 years, but even going back to kind of probably about 2012-ish is where it really started getting tough in South Africa. But I mean, the exciting part is that, trade credit insurance is here. And credit sales are becoming almost a non-negotiable. When we speak to businesses, lots of the opportunities that we talk to are businesses who only sell on cash and now they have to sell on credit. Gareth, we don't know what to do. We've never sold on credit before. But if I don't give my client credit, he's going to buy from my opposition because my opposition is giving him credit. And that really is kind of the space that we're moving into. So people that are well versed with credit and understand the pain that comes with selling on credit, and then people who are just trying to generate sales and having to move to credit. And the difficult component about moving to credit is you don't understand the cost of credit, right? How much does it actually cost you to sell on credit, right? What that means is you're only getting paid. Let's say, if we use the 30 days from statement example, if you sold the goods today, right, on a COD basis, the 12th of November, you'd get paid today, right? You'd have your money. If you're doing it on 30 days from statement, you're going to get paid 31st of December. Now, let's ignore the fact that it's New Year's and it's unlikely that somebody's going to settle on the 31st of December. Let's say that they will. You're now sitting with, call it a 7-week cash flow shortfall. The asset's gone, right? You've sold the stock. You have to pay your suppliers. You have to pay your staff on the 25th or the 20th or the last Friday of November. You've got to pay your landlord. You've got to pay your water and lights. You've got to pay all of your OPEX costs in running the business, but you're only getting paid on the 31st of December. What does that actually do to your business? Those are serious implications and not something that we should take lightly. Probably the most important part, or my favorite part of the trade credit insurance policy, is that the trade credit insurance policy can be ceded, right, to another party. That party can be a supplier. That party can be a bank or a funder or a financial institution, right, in lieu of credit facilities, the other things. That component changes trade credit insurance from a normal policy that's protecting you against bad debts, right, which is obviously prevalent in South Africa, into a mechanism that enables business to transact. If you look at trade credit insurance in the first world and particularly in Europe, you find that the correlation between a financial instrument and a trade credit insurance policy is almost 1-to-1. People don't take out trade credit insurance policies because they're afraid of bad debts in Europe, although that is changing over the last year or two since inflation has kicked up, especially in Germany. And we're seeing business failures. I think Germany has got their record business failure this year ever in history. Right? More businesses have gone under in Germany than ever before. So I'm sure people will start taking out trade credit insurance because they're afraid of defaults. But traditionally, people only take out trade credit insurance because of how they can enable the business. And the next few examples that I want to take you through are the examples of how your client can use trade credit insurance to enable trade and obviously protect themselves in the process. Before I get into the graphs, are there any questions for now?
No questions have popped up.
Are we good? Brilliant. Okay, cool. So first step, let's start at the basics, right? Your client, the policyholder, is selling to clients on credit, but actually there's one particular, how do I keep this on? There's one particular debtor that worries them, right? It could be a single shipment. It could be a single recurring buyer. It could be the single largest account. So an example that we see, I'm not going to say fairly regularly, but every now and then is a client sells to Woolworths, right? So Woolworths is their biggest debtor, let's say, and then they have a few other clients that they sell to. But Woolworths is the one that makes up 80 to 90% of their revenue. If Woolworths doesn't pay, then obviously that's the end of the business. So whilst it's a good credit risk, it's still something that could create a risk for the business's sustainability, right? So that would be a recurring transaction. Or ones that we see all the time is you get once-off deal. I need this shipment to happen. And you want it to happen, but you're actually not too sure if you can handle the capital because you're going to have to buy all those goods before you sell it on to your new client, right? So that's a cash flow strain, or you don't know who the business is and you just want to make sure that you're doing business with the right people. Funnily enough, in this space, that's where we pick up truckloads of fraud, right? In this single debtor environment where somebody is just trying their luck and seeing if they can extract value out of a business who wasn't paying attention. But now we take this exact same policy where the policy is insuring one debtor with Hollard Trade Credit, and we cede the benefit of the policy to a bank or to a funder, right? So there are lots of businesses that provide funding in South Africa. South Africa is in a funny space at the moment. There are people that have cash, and there are people that don't have cash. That's pretty much everybody. And then there's some banks and some financial institutions or financiers that have quite a lot of cash available, and they're looking at obviously at deploying it into the market. So we take this policy, we formally seed it. There's an agreement that happens. It's a tripartite agreement between the policyholder, Hollard, and the beneficiary, whoever the financier is, and we seed the benefit of the policy to them. Right? So what does that mean? Well, that means that because we're ensuring the trade, right? So let's use that example of Woolworths. We're ensuring the trade of Woolworths. We know that Woolworths is a very good credit risk. So from a trade credit perspective, it's really easy for us to ensure that. And we give the benefit of the policy to the funder. The funder then can provide cash to the policyholder to procure whatever that asset is that the insured debtor, or Woolworths in this example, has decided to buy. All right? Does that make sense? So that's what we're doing, is we're saying, I'm going to use a funder to buy the goods for me, so that only once Woolworths settles do I need to settle the financier, and me as the policyholder, I make my margin still, but at least I wasn't out of cash for the duration of the deal. A second example of that, you can cede the benefit of the policy instead of to a financier, to a supplier, right? So this would happen quite often in the building space, where you would have the policyholder would be the subcontractor, the insured debtor would be the main contractor or the principal or the employer of the contract, and the policyholder would need suppliers, right, from a steel business or a plumbing business, or I mean, there's thousands that you could run through here, and you say, well, I'll give you the benefit of my credit policy, right, as long as you supply me those steel eyebars on credit, right? So those are ways that we can enable trade to happen without the policyholder needing to go into a cash flow shortfall by trying to buy all the steel up front. Okay, so we're using the insured debtor or the employer's balance sheet to justify a trade happening, and the policyholder sits in the middle, and they get to make their margin without necessarily encumbering their balance sheet. This is a really powerful solution, one that we're busy working on at the moment, and it's going to upset the retail market quite a bit, is we find that lots of retailers take 60-day credit terms, right? So 2 months worth of credit, and then they pay their suppliers on 30 days, and they take somewhere between a 2.5% and an 8% early settlement discount or rebate, or depending on how they want to call it. Well, I suppose if it's a rebate, it's a bit trickier. But, you know, it's normally they phrase it as an early settlement discount. And what we're busy testing is we're saying to the policyholder or the supplier to these big retail stores, well, take your 60 days. Actually, I don't need my money on 30 days. And we're going to include a financier in the background who's going to pay the policyholder on 30 days anyway. And then the policyholder only needs to pay for 1 month's worth of finance. And that cost is, I'm going to pick round numbers here if you don't mind, is about 2%, let's say 1.5% to 2% a month. So the policyholder is spending 1.5% to 2% a month, but they're clawing back between 2.5% and 8% from the retail store who now that early settlement discount. That's quite powerful, right? And that's a way to increase margin inside your client's existing business. Back. Did I never leave?
You
Yes,
never
we
left.
can still see you.
Okay, sorry, I left. I couldn't see. Okay, so I hope that's a really good example of a single buy trade and some useful applications for it. The next component, or the next kind of example that we wanted to go into, is what we call as a named buyer solution. Those are typically for policyholders who are not looking at insuring all of their debtors, but they have some, a key set of buyers that are large enough to go under. So it's not quite the Woolies example, but it's that typical 80-20 principle, where 20% of your debtors make up 80% of your revenue stream. Only insure those 20% of your debtors, or You may have some troublemakers who are kind of constantly late, and we would have a look at those for you. If they're constantly late because they're going under, obviously that, those are debtors that we wouldn't want to insure. But typically what we find is that everybody stretches everybody, right? So you're supposed to get paid on the last day of the month. I'm going to push you to the 7th of the month. That's bought me some cash flow time, right? So those aren't necessarily bad payers. They're just slow payers. That's that kind of frequency. So it's not that they're not going to pay you, but it's the fact that they're paying me so late that it affects my cash flow cycle. And actually now I'm out of pocket at the end of the month again because people have moved the last day of the month to the 7th of the month. All right. So that's kind of how you would use a named buyer policy. And again, in the example of ceding it to a beneficiary, what we find is that a named buyer policy ceded to a bank, let's say in this example, is quite useful when you're looking at raising a specific overdraft or a specific short-term cash flow requirement, right? So it's not your business's your standard business process, but you're going through a bit of a tight squeeze at the moment and you need to access some cash, or you're looking at doing a capital upgrade on your factory or your warehouse or whatever it is, using the trade credit insurance policy on a named buyer basis because you know how much you're trying to attract. You then get an overdraft facility at the bank using a trade credit insurance policy as security. All the banks accept a Hollard Trade Credit insurance policy as a meaningful security in lieu of an overdraft. And then again, what's quite useful there is if you know how much you need, you only need to insure the number of debtors required in order to generate that facility. Typically, banks operate between a 50% and the insured percentage level. So our policies have got an 85% insured percentage level, meaning that if we insure R1 million, we'd pay out 850,000 Rand. Remember that that's on the selling price. So your profit is kind of linked into the excess. So if you were needing, now let's go the other way around. If you had 10 million rands worth of debtors, you'd be able to raise between a 5 and an 8.5 million rand overdraft facility, insuring those 10 million rands worth of debtors, as an example, right? So at least now you're saying, I know that I've got a 5 million rand example. Let's only insure my 5 biggest debtors, and then I can get the overdraft facility. I'm not really worried about them going under, but at least Hollard is there to protect me if they do. They're there to protect the bank if they do. And more importantly, Hollard is there to perfect the debt and to collect the debt at our expense once or if there is a default. So you kind of got 2 layers of protection there. You've got the debt or the capital component, and then you've got that legal recovery portion. But you're not wasting money insuring all of the debtors that you don't need to insure. Okay. One last example, I think, on standard trade credit insurance. And this is obviously an all debtor principle. It's a bit of a messy slide, but it kind of is a messy policy. That's when you're insuring all of your debtors. And that's kind of rarely used for good credit governance. That's where we see, traditionally the market only offered all debtors or a whole book cover. When we got into the market, we started doing single debtor and named buyer. So for us, those types of policies are pretty normal, but this all debtor principle is the one that's most common in the market. And that's where you would have a scenario where typically your finance director or your chairman of the board would pick up the financials and go, crumbs, I see our outstanding debtors are either, growing too quickly because nobody's paying us, or they're just becoming large enough that they're becoming a meaningful number on the balance sheet and certainly a risk that you need to protect, right? If you remember, trade credit insurance or debtors is an asset on your balance sheet. But if somebody doesn't pay you, it becomes a liability almost overnight. Whereas your warehouse or your factory or the land cannot lose value overnight. It can degrade, absolutely, but it doesn't lose value overnight. Whereas your debtor's balance, every time somebody doesn't pay you, it moves across, directly across to the liability side. So certainly from a good governance perspective, it's never a bad thing to insure all your debtors. And the benefit of insuring all your debtors, and this is what they do in Europe, like I said, we're in the first world all the time, is you use it to create permanent financing facilities. So overdraft, like kind of meaningful overdraft facilities or debtor factoring solutions, where you insure all of your debtors, and that creates the overdraft facility, and that allows you to operate almost as if you're selling on cash, because the bank's giving you the cash or a cash availability every month. That allows you to run the business, and then when the debtors settle, obviously they settle into the account, which then reduces how much is available in the overdraft of the facility. But then when you sell again, obviously the price goes up or the value goes up again. The more, there we go, the larger the debtors, the more debtors you insure, obviously the larger the facility, and I mean, if I can be. It's quite an important process to manage. I think you certainly need to, your client needs to make sure that they understand what they're doing with the bank. They don't want to get into a cycle where you're spending next month's money before you've got it, right? You've got to be quite meticulous, I suppose, or regimented in how you manage these types of facilities. But it really does buy you a free month's worth of cash flow when using a trade credit insurance policy and ceding it to a bank for a debtor factoring solution. These are just two. The next two are really interesting uses of credit insurance that we found in the last few years. These ones are not as simple as they may be, or as they may look, and the solution to be put in place is also dependent on the funder. But at Hollard, we can assist you on the trade credit space and potentially on the payment guarantee space if it meets, if it meets the criteria. But in the credit mismatch world, you typically have a supplier who supplies, let's say, your client, the policyholder, and those are regular businesses, 30-day credit terms. But the policyholder is selling to somebody abroad, so it needs to be shipped, right? So your credit terms are going to be extended because it needs to go through port. Or your debtor is a farmer. That's the one this is where the credit mismatch came from. And a farmer only harvests once a year. So you typically have to give a farmer 270-day credit terms, right, for the farmer to manage his harvest. And then he can pay you. But because the policyholder has to pay the supplier on 30 days, they can't give the farmer or their clients the 90 days, right? So that's what's happening, is that the supplier's terms are shorter than the client's expected terms, and either the policyholder has to pay the supplier without being paid by their debtor, or they need to turn the debtor away because they can't afford it from a cash flow cycle perspective. So what we do is we introduce a financier again, and we take that exact same trade credit policy. We're insuring your farmer. The first step is we seed it, right? We formally seed it to the beneficiary. We then supply to the insured debtor. Let's call it a farmer, if you don't mind. So we sell all the seeds or the fertilizer to the farmer. We confirm the debt. Obviously, I think that's quite important, that when you sell it, you confirm that the debt exists and that the debt is good for it, because the financier would require that the debt is covered. The financier then pays the supplier on the agreed terms, on those 30 days from statement. So the supplier is not out of pocket, the policyholder is not out of pocket, and the policyholder then waits for the insured debtor, in this example, the 90 days or 270 days in the farming example, to settle the debt. Obviously, the invoice value to the insured debtor would be a little bit higher, let's say, because it's going to take you longer to recover the debt, and those are mechanisms obviously at your disposal. But this is a really smart way to turn this structure into a structure that your client doesn't have to turn away, because they don't have the cash flow to handle the transaction. Is it the last one? I think so. The next one is the working capital cycle. This is probably our newest solution that we put into the market about a year ago. And what happens here is similar to the retail example that I used earlier. The supplier would supply a client who obviously sells to the debtor, but the supplier also offers an early settlement discount. So you can pay R1 million on 30 days, or you can pay R1 million less 2.5% if you settle within earlier than the 30 days. All right. So what we do here is, again, we take put a funder in place, but in this example, the funder becomes the policy holder. So the bank or whoever the financial institution that would be settling the supplier is the policy holder, right? The insured debtor becomes the client or the client's client, so the debtor in this picture. Okay, so that's where the insured transaction is. And the policy holder, sorry, the supplier supplies to the client. The client confirms that the debt is due and that they're happy with whatever they've received, whether it's laptops or steel or whatever it is. And the policy holder, which is the funder, pays the supplier, gets that early settlement discount, which is then forwarded on to the client. Now, in this typical example, the client could be, and I'm just picking numbers here, 0.5%, the client's paying 0.5% for the facility or the insurance component of it, plus 1% to the bank for the funding line for that month, right? So it's costing them 1.5%, but the supplier is giving them 2.5% early settlement discount, which means that the client is making an extra 1% every time they buy anything. Now, it's not quite, dog food's on sale, let's buy dogs, but it is quite a useful way for the client to increase their margin with their existing business, right? So these are some powerful solutions to turn your business around without it actually costing more money. Because if you look at the way it works, all the costs get absorbed in the process, especially in these funding type solutions. Next steps. This is the exciting part for me, is let's start talking to your clients. Let's see where they need it. Everybody. I haven't spoken to anybody that isn't thinking about the world a little bit differently. COVID certainly stripped a lot of cash out of the environment. And then the 9 interest rate hikes that we had in a row certainly stripped a lot of cash out of the economy as well. So let's start talking to your clients. Have they ever complained about how tough the economy is? If they have, then that's certainly a conversation that I'd love to have with them, provided they sell to businesses, right? Obviously, if they sell to individuals, that's not eligible for the trade credit policy. Right, let's test if your client is eligible for trade credit insurance. Do they sell on credit? Can they sell on credit? Right? Those are two of the most important things. The next component, do they buy on credit? Because then we can use this solution if they are buying on credit, and we can see how we can get them to make more margin out of the same deal that they make. The most important component here for me is really to just chat to your customers, right? Do they sell on credit? What is, how do you determine whether you're going to sell on credit or not? How do you determine whether a client is eligible for selling on credit? Do you have a credit agreement in place? What happens if they don't pay you? Right? These are kind of simple questions, and I think really good questions that we should be having with our clients, especially in this tough environment, right? Like I said, they get in touch, trade credit at hollard.co.za. So Levy Default is the one, and trade credit is the other one. Please get in touch with us. And then something that I added, funny enough, this morning that I just thought about, because it's a constant problem that we have. Hollard and iTOO have got lots of brokers that support us, but very limited in trade credit experience or knowledge. And then we've got a bank. When I say we, I mean South Africa has a bank probably of about 20 to 30 specialist trade credit insurance brokers, most of them who only do trade credit insurance. So if you're a broker who is interested in trade credit insurance and you can understand that it is required, right, for your client, or certainly something that you'd like to engage with your client, but you're not comfortable having the conversation, many of these trade credit insurance brokers are happy to conclude some kind of a commercial agreement with you where they would assist you in managing the policy. And I'm not too sure what the commercials look like in the background, but I'm pretty sure there'd be some kind of a commission share or some kind of a fee or something like that. But at least then you know that your client is getting the best service possible. One last kind of important component for me on that is trade credit insurance is an admin-intensive product, right? It is, unfortunately. It's something where you have to engage with the client at least on a monthly basis. And I say at least because you have to do premium declarations and there's some work that's required. But every time your client gets a new client, that would be an interaction on the trade credit, or could be an interaction on the trade credit insurance policy, right? So every time your client has a new client, there'd be new work to be done. So it is quite labor intensive, but you're engaging with your client so much more frequently. You're developing a far richer relationship with your client, far more embedded with their day-to-day operations. And technically, you're being introduced to their clients. So I suppose there's a potential lead opportunity there too. That's it from me. And then just this is something that I really like. And this is Patrick Enthoven used to be the chairman of Hollard when I joined. And there must be a better way of doing things. I mean, that just resonates with me to my core. So as long as we keep talking, I think we can do many, many things together. So that's my last call to action, is give us a ring, drop us an email, either on trade credit at hollard.co.za or on Levy Default at hollard.co.za, and let's see how we can turn this economy around, right? I'm fully committed, and so far so good. We've really managed to make a meaningful impact on some of our clients and on some businesses. I see I've got 7 minutes. If I can, just before I open up to questions, if there are
quite
any.
a few questions.
Oh, are there? So last example,
Yes.
I just have to give one, if you don't mind. Hollard Procurement and I, we had a chat about enterprise development, right? And they had 2 individuals who were startups, and they made bricks, right? They were starting to make bricks, but they had no credit worthiness, they had no cash, they had no balance sheet, but they had a contract to supply bricks to quite a big hardware business, right? So that's a good credit risk for us. And what we did there is we used that one solution that I presented earlier, where we insured the big retail chain, and we ceded the benefit of the policy to a cement manufacturer and the soda ash provider. And we used that credit facility for them to stimulate trade. Our enterprise development entrepreneurs started making bricks and started supplying the bricks to this retailer. And that's a real business now, which is quite exciting. So people that had no capital, they had a track record of making good bricks, but they had no capital in order to actually generate anything. And we've turned that into a real business using a retailer's balance sheet. Now I know it's exciting for me, but that's certainly, I don't think there are many businesses that can turn away an example like that. Sorry, Ellen, you said there are questions.
Cool. So I'm going to quickly touch on 2 or 3 of the trade credit ones, and then we are going to divert back to the levy default again. So on the trade credit, would the value of the credit be inclusive of the profit? So correct, because it's the invoice.
Yes, the selling price.
Yeah.
Correct. So we're ensuring the selling price, and we always make sure that our clients are covered for at least their rent, their staff bill, and their suppliers. Because if their suppliers don't get paid, you don't get supplied, end of your business. If you don't pay your staff, they strike, you go out of business. If you don't pay your landlord, you don't have premises, you go out of business. So at least those 3 things need to be 85% of your selling price. If they're more than 85% of selling price, we will increase our insured percentage to make sure that the policyholder is adequately indemnified in the event of a loss.
Are there any specific declined creditors or types of creditors?
So I mean, obviously we would underwrite each and every debtor, and we do decline a few or quite a lot. Government departments are typically quite difficult to insure. State-owned companies quite difficult to insure. But what is important is that if we cannot insure the buyer, we will tell the policyholder why. It's one of the reasons why we make sure that the credit agreement is in place, and that from a POPI perspective, we've got consent to underwrite the buyer and share the result of that underwrite with the policyholder. So when we do decline a risk, we'll tell them why we can't, so that the policyholder can decide whether they want to trade with that buyer or not.
Then just a practical question, waiting period on default of payment. So what is our average waiting period once there's a default? So I think that goes to our policy wording,
60,
which I think maybe we can share that document as well with the pack.
Exactly. But typically, if I can say, there's no real waiting period on a policy. If a debtor goes into business rescue or liquidation, or we obtain a judgment, we'll pay straight away. If we are confirming the debt, we only get involved 60 days past the original due date. So we give the policyholder 2 months to negotiate with their debtor before we get involved, because a policyholder would way rather manage the relationship with their client and make sure that they can buy from them next month, whereas our job is to collect, unpaid debt. So we give the client those 2 months. But if that 2 months is too long for a client to wait, let's talk. We discuss the rules of the policy, and we'll put a policy in place that matters or is meaningful for the policyholder.
Great. Then 2 separate questions. So how big is our appetite for, say, cover in the Middle East and China? And then a second question, it says, is cover extended into Africa?
Okay, so those are, so both export policies. We do have an export policy. I won't lie. Export is not particularly, something that's on our agenda. We accommodate clients for an export basis. Middle East, Africa, Far East or China, all complicated regions, nothing the same. Middle East is becoming a little bit more formalized. Before the last few years in the Middle East, if there was a default, people would just vanish. Whereas now people don't vanish after a default, so you can actually recover and you can remedy the debt. But as long as we've got sufficient information to underwrite the risk, we'll likely to provide cover. There are a few trade-sanctioned countries that we can't insure in at the moment. A place like Zimbabwe, North Korea, Russia would be an obvious one at the moment. So we've got a few trade-sanctioned countries, but if they're not in a trade-sanctioned country and we can underwrite the buyer, absolutely we'll do the cover.
Then just quickly jumping back to the levy default, quite a few questions around sort of, can we look at the levies, sort of the budget at the beginning of the year and change it to an annual policy, possibly with an adjustment at the end of the term, which I think we open to discussions on.
Yeah.
And then administratively, will the brokers do sort of some of the administration, or will Hollard be collecting the premium and sending out the policy schedules? So just the sort of the process in terms of who's responsible for what. And I'm very conscious of it's just hit 11 o'clock.
Yes. So the short answer is we would be handling the invoicing for now, right? So for now it's been set up that we would be handling the invoicing. We'd be sending out the policy. I have had a request to understand if we can include it under a typical Hollard binder. And I've got a meeting with the binder holder just to unpack what the process would look like. And then I'll certainly take it to the binder area inside Hollard just to make sure that we can, in fact, issue the levy default product under the binder. If we can, we're not too precious about controlling it. As long as we've got line of sight of the risk, we're happy to play, where you need us to play.
Okay. And then do we cover commercial body corporates?
That's a good question. Yeah, absolutely. Yeah, we would. As long as the rules are the same and as long as it falls under the same act, absolutely, we would look at commercial body corporates.
Great. And then a very practical question: what is the broker commission rate on these levy default policies?
So at this stage, unfortunately, it's 12.5%. We are looking at increasing that. We just want to see what the experience is in the market and how the product rolls out. For now, we've built in a 12.5% commission rate, but obviously we would be able to go up to 20%. And given the fact that the other insurer exited the market in March, because of losses, we just want to make sure that we've got this right before we increase the broker commission.
And then maybe just in terms of time, a couple of people have asked whether we will share the slides and whether this recording will be available. So I'll refer that to Tove and Shazia and just communicate through them.
Cool. But I don't mind if my slide deck will go out. I'll send that to Tove and Caesar and they can do what they need to.
Perfect. And then I recognize we've missed a few of the more technical questions. I have made notes of those, so we'll just be in contact and share the facts and the FAQs. And if you've got any other questions, please just feel free to contact us.
Awesome. Cool. Thanks, Celine. Thank you. Thank you, everybody. I hope, sorry that we ran over. That's actually the best I've ever done, to be honest. I look forward to chatting with you all soon in the future. as we keep building and rebuilding South Africa to, make South Africa great again. Have a brilliant day and a great week further. Take care. Bye.
Thank you, Gareth.